This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings and welcome to the Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I am joined by our macro advisor, Edge Manager, Craig Shapiro. We're just so excited to be able to finally, kind of put our teeth into some of this momentum exhaustion that has basically transpired since the momentous bounce last week that started with VIX suppression Monday into the FOMC meeting on Wednesday, and then with Yellen and the quarterly refunding announcement. So we are actually coming here to I guess, recap what happened today, this afternoon, with the 30-year Treasury auction, and Powell also spoke. So Craig, take it away. Catch us up on how this day unfolded on macro events.
Yeah. So, look, I think we had a market that was very weak in the month of October, was fighting this idea of a sticky inflationary environment, strong GDP, and a lot of Treasury issuance, and yields were moving, sustainably higher, and we were above 5% for, I think, the entirety of the curve. This was like basically through the last day of October. Lo and behold, Yellen comes out with her, more dovish than expected issuance calendar for the fourth quarter, and then specifically for the first quarter, as she tried to and did dampen down worries or fears about duration and supply issuance by basically saying she would be issuing more bills than bonds. Hold on one second. Do you see, Samantha, you see this message in the chat that they can't see our faces?
That's strange because we are broadcasting. Maybe someone else let us know. We have okay, that's user operating error.
I wanted to make sure that we saw that. Sorry for that.
No worries, that's important.
Yeah.
Malfunction I want to avoid.
Okay, but so Yellen comes in. She basically says they're going to do more bills than bonds, and alleviate some of the fears about supply growth. And then Powell comes out on the afternoon on Wednesday, the 1st, and look, when I heard it, and I had said this in my room when I listened to the statement and press conference, I didn't come away with the idea that this Fed was ultimately, turning substantially more dovish. But in light of the vol suppression that we saw, both in equities and in fixed income, and the rally in bonds on back of the Treasury announcement, the market just kind of exploded higher last week, and particularly in the latter half of last week. And I think NASDAQ is, had been up 8 days in a row until today. And so the question, 9 days in a row. So the question then, and I have been talking about this, tons of Fed speak this week. Was the Fed going to actively push back against this pricing? And the reason I thought it was possible they would is because we saw a very significant loosening of financial conditions over the course of the last 10 days, right? You had the dollar weaken, you had yields come in materially, equities rally 8-9 days in a row, vol crushed. And what that means, what that allows, is these animal spirits come back, and inflation expectations can start to come back again and creep higher again. And that's, then puts the Fed in a challenging position. A Fed that had said it, thought that maybe the market was doing some of the work for it. Then all of a sudden bonds rally, yields fall, and all of a sudden the market's not doing the work for the Fed anymore. So my thought was that we would hear some of that this week. For the most part, the speakers that came out this week, modest pushback, not material pushback, modest pushback. Many of them had said, look, if inflation reaccelerates, we still could do more. This idea that the market was doing the work for the Fed. Two members today actually mentioned that bonds had rallied this week. So, there was some, and then the question then became, what was Powell going to say? So but for order, the sequencing though, first, before we got Powell, is we got this Treasury 30-year auction, which, basically was a disaster. It was one of the worst 30-year auctions I think probably we've ever had. A 5 basis point tail, bid to cover, I think it was 225. Dealers had to take 25% of this versus kind of historically taking 12, 13% of the 30-year issue. So this was a pretty bad auction, which came on the heels of yesterday's 10-year and the day before's 3-year auctions, both of which came in fine. Although now you've lost money in any one of those auctions. If you bought an auction this week in the 3-year, 10-year, or the 30-year, you've lost money. So clearly the market didn't digest this last piece of paper, very well. And it's not surprising. I'm not sure who would want to own a 30-year U.S. government bond in light of the accelerating fiscal deficits we have, that are going to continue forever in a dysfunctional D.C. that can't tax and can't cut spending and just going to keep printing money in order to fund the difference. So it didn't really surprise me because I would never buy one. But today, clearly, nobody really wanted to buy it. So
I have to show you something real quick just because you're talking about it. Here is a 30. By the way, I've got multiple on now. My version. All right. So can you see it? All right. Yeah. So here's the 30-year just for the Treasury bond price. Beautiful, by the way, 40-year trend channel, right? So this beautiful head and shoulder, that's what broke down in October 2021. Anyway, we're down here. We haven't even taken into account with this kind of 30-year. Hopefully you can see down here. We haven't based enough. 100 is a really nice level, but it goes all the way back to 2004. Anyway, the point is, when you say you wouldn't pick up the 30-year, and we talked about this when this bounced, you said you still didn't trust it, and it rolled over strongly in 2022, 2023. So it basically is still not done going down. Is your baseline bet?
Yeah, I would say that's accurate. Okay. And so that was your 1 o'clock event. So markets did. And I had mentioned in the chat, kind of was a clear signal for me to press some shorts. And look, that was the 1 o'clock reaction, because that was the first kind of the bond market saying, yeah, maybe we've loosened too aggressively. Maybe this is not the right move. That supply is still an issue. Term premiums are probably still too low. Need to move higher. So that brought us to 2 o'clock. And look, Powell, the speech was more hawkish than I thought it would be. Even though I thought he would push back, even though I didn't want him to push back. Well, I did push back, but he typically doesn't, aggressively push back. But it did seem today, like in this speech, he was acknowledging that the loosening of financial conditions post his meeting was not desirous, and that for the market to aggressively price in rate cuts for 2024, we know the dot plot is looking for 2. The market went to 4 after the Fed meeting. And this rally in bonds and loosening of conditions, I think, was not desirous. So the key statement in the speech was this: while the broader supply recovery continues, he was talking about supply chain helping bring down inflation. It is not clear how much more will be achieved by additional supply side improvements going forward. It may be that a greater share of the progress in reducing inflation will have to come from tight monetary policy, restraining the growth in aggregate demand. So he's basically saying, the momentum we've seen so far, had a lot to do with the supply chain loosening up, and that from here, in order to get us back down to 2%, we're going to need to be tight. We're going to need to be tighter for longer. And so he mentioned, there were a bunch of different quotes, from the speech. That kind of intonated, not that it was new, but it was just like a reminder to the market, like saying, hey, the process of getting to inflation to 2% has a, quote, long way to go. Fed won't hesitate to tighten more if appropriate. Not confident we've achieved a stance to hit 2% inflation. He was like banging us over the head with that messaging. And so given how much vol had compressed, given how much the markets had positively reacted prior to that, this was, his way of pushing back. And when you did the 1-2 combination of the failed Treasury auction and Powell, today you find yourself in a bit of a risk-off event, in a window of time where we know that flows are more supportive, right? So we know this is not the window of weakness is not open. We know expiry is next week, and the run into expiry with the buyback of hedges and time decay makes it harder for markets to react to macro. So you need an outsized macro move, but we kind of got that today. So markets had a challenging day. Although, look, I mean, S&Ps were down 75 basis, right? And many of the big cap tech stocks were I think still even green. I mean, Nvidia was green and Apple was basically flat. So it wasn't like it was a catastrophe, but the things that I would have expected, like cyclicals and small caps and banks to underperform, that's where we're seeing the weakness, right? That's where we continue to see the weakness. So the odds of a rate hike for December moved marginally higher. I still don't think they've moved enough higher. We're still only looking for like a 15, now we're up to like a 12, 13, 14% chance of a hike in December, up from 5%. I think if we get a hot CPI print next week on the 14th, the odds for December are going to move up materially, because this is, the Fed needs to be seen as credible. And in the SEP from September, a majority of members said they were going to see a rate hike this year. So if we get a strong core services inflation print next week, after a very robust third quarter GDP number and a labor market that is not yet rolling over materially, I think you're going to see the odds of a rate hike move up, probably closer to 50%. And if that happens, I think the markets are not gonna react favorably to that setup. So
no, because bulls have to have the hope that we're still in immaculate disinflation, right? So this is falling inflation against steady economic growth. So any signs of that countering the narrative, there should be some de-risking. But in the midst of all of this, we still have some very, very strong flows, as you mentioned. So we really do need more macro triggers than today, although today was a really good start to kind of take the air out of that very large outsized event bounce from last week. I mean, that was the strongest bounce we've had all year, strongest in 3 years. Historic VIX move in 1 week, 7th largest dump weekly downdraft for VIX in history. There were a lot of very outsized moves that need to kind of be unwound potentially. What else besides the CPI is coming up for kind of macro risk? And we definitely want to open this up, by the way, for questions. Like we do this all the time for clients. We're day in and day out for clients. But when we make this publicly available, we want to let folks know that you can ask us questions of anything you want: recession, inflation, gold, Bitcoin. So let's just kind of like round up though an overview of what's happened and then kind of go into Q&A. What do you have for event risk besides the CPI next week?
Yeah, so the macro calendar, look, tomorrow we get this UMich survey, which is interesting. I mean, we've definitely seen a pickup, a reacceleration of inflation expectations in these UMich surveys. Oil has been down since the last survey, so it's possible that we won't see another pickup there. So that'll be interesting to tell. And then next week, like I said, CPI is on the 14th, which I guess that's Tuesday. Retail sales is the following day, the 15th, and PPI as well. VIX expiry is Wednesday morning. Regular expiry is Friday afternoon. So, look, that means positioning and pin risk is around. So, we would need to see, I think we would need to see a pretty hot CPI print in order to kind of dislodge some of the, the potential for pinning activity for next week. But it's very possible. As far as the Fed is concerned, I mean, look, we had Powell today, Daly speaks tomorrow, Logan tomorrow, Bostic, but I think we're in the, it doesn't really matter as much after we kind of got from Powell today. It will be interesting to hear if other members kind of follow on with some of that hawkish messaging. Next week, there's a Fed Treasury conference that Williams and Barr are speaking at. But, look, I think, next week's will be about expiry and about CPI and retail sales. And I think what we had, at least up until today, is, some of the macro data that we've been seeing has been showing signs of deceleration and a growth slowdown, right? We saw, particularly in Europe, pretty bad IP numbers. European PMIs have been poor, and the China activity numbers as well have not been good. So there has been a narrative developing in the market about a growth concern, right? And I think that is why fixed income had acted as favorably as it has, and folks were kind of feeling you could buy bonds because global growth was slowing, and that led to a follow-on. Well, if you're going to buy bonds, then you could buy equities. So that this narrative of a growth slowdown, being disinflationary, I think allowed for markets to levitate, a bit. So that could be challenged on two fronts next week. It could be challenged on the CPI front. If CPI comes in hotter than expected, the prospects or the narrative of stagflation is going to set in. And if retail sales comes in better than expected, similarly, it would be seen as, wait, maybe growth isn't really slowing. Fed's likely to have to do more. Now, I think it's also possible and eventual, and you have this continuing claims chart up here, and we'll get into that too. But at some point in the coming months, we are going to have a more significant slowdown in activity in the US. Now, is it recession? Is it not? I don't think it doesn't really matter, to me. And they don't really matter to the Fed. I think what is interesting for markets is the Fed's reaction function and the ability to respond to this growth slowdown. And so I just don't see a labor market that is deteriorating rapidly enough to slow down wage growth that would slow down core services inflation to bring ultimately core PCE down %. That's why I think the Fed is going to be late to providing stimulus. They're going to be late to stopping the tightening, then they're going to be late to giving stimulus to this economy. So when the market front runs the Fed's reaction function and starts to price in cuts aggressively and starts to rally equities and rally risk, it's really getting the cart before the horse in a very material way. So I think we are going to have we are having a slowdown. We're having a slowdown in housing. We're having a slowdown in interest rate sensitive areas. We're having a slowdown in autos. And that rolling slowdown is going to continue. It's just going to happen more slowly, I think, than people think. And the labor component of it, I think, is going to, challenge the consensus narrative. Where are the layoffs coming from? I don't see them. I mean, I don't see tech. Last year, we saw tech layoffs because tech stocks got destroyed. We're not seeing tech stocks get destroyed now, so we're not hearing about any tech layoffs, right? The equity market needs to kick the corporates in the butt, right? And force the layoffs. The CEOs only react to their stock prices being down. When their stock prices are up, they're not going to engage in layoffs. When stock prices are down, then they engage in, more aggressive cost cutting. You're seeing some of that from the banks now, right? Citigroup is talking about more layoffs. Some other big banks are talking about. So that makes sense, right? Financials have started to come under some pressure. So maybe you'll get something there. But as far as construction, which is a big employer, we're not really seeing any acceleration of layoffs there yet. In service and leisure, not really seeing it. In government and education, we're not seeing it. So, there are calls for a negative payroll print like imminent. It's just not. I think we're not there yet. And so,
when we get there, it's a pile-on effect, but because of those that want to kind of like go with the flow for cover, but they've been holding off, but we're not there yet. Admittedly, we haven't hit my threshold.
Yeah, and I think because
jobless claims or wage.
That's right. And because we're not hitting that, the Fed is not going to react with stimulus, by stimulus rate cuts or whatever. They're not going to react quickly because they don't see the need to, because inflation is still too high and the labor market is still too firm. So when the market prices in an aggressive cutting cycle, the Fed has to come back and say, no, wrong, which I think is what Powell started to try to do a little bit of that today.
So you made a comment also in kind of recession framework, but not, and stagflation more to the point, I think. Oil market rapidly transitioning to being concerned about global growth momentum deteriorating. The issue for markets is that the labor market remains too firm and wages too strong, such that core services inflation stays too high for too long, preventing the Fed from reacting to any growth deceleration. The Fed will be late to ease policy, and impact of eventual rate cuts will take longer to actually improve conditions. Stagflation environments are real tough for risk assets. That was what you wrote for clients. What was the time frame of that? When does that kind of start to become more of a headwind for equities?
Yeah, look, I think anyone would be surprised, given the geopolitical concerns, how weak oil has been over the course of the last 2 to 3 weeks. And so, because we know that supply growth being restricted by OPEC plus, Saudi and Russia have continued to take barrels off the market. So, as there's rising geopolitical tension, the potential for the Middle East strife to move further, get more aggressive, you would have thought that the oil market would get even tighter And so the fact that the oil market has rejected that premise suggests, I think, that folks are more concerned about demand for oil than they had been previously. And while I don't think that demand concern is necessarily coming out of the U.S., because we've largely seen, a still firm demand environment here, the data out of Europe and out of Asia, particularly China, has been such, I think, that demand concerns are becoming more top of mind. Mm-hmm. And so there was a bit of demand concerns are out there. Oil is selling off, which is leading to bonds rally on kind of growing recessionary fears, which for some reason, right, was leading to equities up because equities were basically going to be benefiting, I guess, from this multiple expansion that comes from the lower interest rate environment. But that's a fleeting exercise. If we are, in fact, going into recession, which I suspect we are going to be going into one, as I mentioned, in the US at some point next year, but globally, we're going to be seeing that sooner. You don't want to buy equities that are going to be facing deteriorating earnings outlooks. And so again, I think it's about this kind of very bifurcated equity market that we have, at least in the US, where you have, Mag 7 plus Lilly, right? So that's the new Mag 8. So I guess that's the Mag 8. You have 8, 15, whatever the number is, very good stocks that are cash rich, that are benefiting from a higher interest rate environment, that still have secular growth momentum to it. And then you have the other 485 stocks or so that are having a much harder go at it. And the areas that are going to suffer from growing recessionary momentum globally are things like banks, small caps, some cyclicals, industrials, and the like. So I think that's the reality that we're in. So that comment was kind of geared towards, underweights in Europe and in small caps and in banks. And this idea that, well, the Fed's going to react to it, so you don't have to fear it. I think that's the misplaced part, because I don't think the Fed is going to react aggressively to a growth slowdown. And the Fed is certainly not going to react at this point to an earnings growth momentum slowdown if that earnings growth momentum slowdown is being driven by higher wages, right? I mean, because that's the inflation part of it. So that's where now if and when it's going to affect Apple and NVIDIA and Microsoft. Truthfully, I don't, to be honest, I'm having a tough time finding, a real structural underperformance case for Mag 7, names. And part of that, I think, is they've continued to be increasingly seen as a safe asset, right? And I think they're even becoming safe in comparison to U.S. Treasuries, right? I mean, not T-bills, but do you want to own a 30-year bond on the U.S. government, or do you want to own a 30-year bond on Apple, or do you want to own Apple equity or Microsoft? I think there's an argument to be made for some of these corporates over sovereigns. And I think there is an element of people who are saying, I'd rather be involved in some of these stocks that have pricing power, that have cost control, that can grow free cash flow, particularly if I compare that to a U.S. government, which has no pricing power, has no cost control, and can only print more money to pay its bills. So that's the dynamic we're seeing. And we're seeing, Qs versus IWMs making new highs every day, right? Qs versus SPYs or Qs versus any other sector are making new highs regularly. And I think the market is seeing that. It's accelerating that trend. Corporate buybacks are favorable, right? All those companies basically buy back stock. Many other companies don't. So from a passive perspective, there's momentum there. So I don't think it makes too much sense to try to, use those as the vehicles to be short when you could be short, some of these other areas in the market.
All right. So what I'm showing right now, and most have probably already picked up on this, in fact, the Mag 7, right? The Magnificent 7, not the NASDAQ 100, but it mirrors the NASDAQ 100, obviously. It also mirrors, if you put the NASDAQ 100 next to the Nikkei, it looks just like this. So it's kind of interesting. Yes, but I'm gonna slide this in. I did a video this morning, actually for clients. It's going to be posted, a snippet of it, for anyone who's interested, on YouTube tomorrow, which is talking about kind of the Magnificent 7 breakout that we have seen since October 26th. So literally, I posted this for clients and said, we're either going to bounce hard or trounce hard right here. And obviously that's a directional move, but we got to see it. And that was the Friday before the gap down, right, leading into FOMC last week. And we had already talked about that we were expecting, as every Monday before it, to have the VIX crush, right? It's what, 18 Mondays in a row, whatever it is. We literally talked about it the Thursday before, in expectation that VIX would be, depressed, compressed, suppressed into FOMC. And then we'd have to see. And then we actually got the Fed statement, and then we got Powell's intonating pause and Yellen coming out with a QRA. And it was very different because it was more heavily skewed toward the short term and bills versus bonds, which are kind of kicking down the road there. So long story short, we had a massive bounce that was also fueled by short covering, et cetera, et cetera. So we've talked about all that stuff. Now here we are, right? And it's the same thing. Everyone's looking at the same technical chart on a weekly, 4 Qs for the Magnificent Seven, and we got to see what's going to happen rest of this week and beyond. But this is the other chart that I kind of will just briefly show here, and then we can kind of move on to other questions and such. But that's that big NASDAQ, to SPX ratio chart that I have just kept on very, very firmly since fall of 2021. And the rollover, NASDAQ underperformance through 2022, and then massive intervention. We're talking massive intervention globally through that coordinated, October, September timeframe. Anyway, this kicked off very much the January effect and the bank bailout, and here we are. So literally on that 2 weeks ago, I mentioned this was, the major bouncer trounce area, and we have on this indicator gone right up into a trend line. We get above, and it will be very, very strong impulse higher in NASDAQ, and other breadth plays will come into play, right? Other stocks will actually get excited about that too, and we'll have a bounce. The question is how strong, and that's what we're talking about right now, right? The kind of the Santa rally, the FOMO that usually kicks in, and seasonality. So we have lots of reasons why folks are excited about this bullish backdrop into end of year. Now give us the bear case, because we haven't actually broken out. Today we got firmly rejected, and it makes sense. Logically, 9 straight days of green up in NASDAQ, and then it pauses, and then it digests, then it rolls over. But this is really, the question I'm asking you for a bearish view into year end, when everybody, is positioning to not miss this 1999, great explosion higher, or whatever they call it.
Yeah.
So talk about the bearish case, because I think the bullish case is pretty well established.
I think that I think the market is would be most concerned about a resurgence of yields moving higher. And so the question is, how do yields move higher from here, in light of the most recent data from the Treasury on the refunding and supply. And so I think in order to get bond yields up into the end of the year, you would need to see higher than expected inflation prints.
Fair
enough. I think if we were to get now, look, oil dropping, as it has, may make it difficult for yields to move materially higher. So if somehow oil finds a floor and rallies back a little bit, and then yields go, I think that would be a problem for markets, because we've seen whether it was last year or in the third quarter of this year, the broad markets, not forget IWMs or cyclical, the broad markets seem to struggle most when yields are moving higher at an accelerating. And so the only way to get that would be, I think, with hotter than expected inflation prints that kind of let people to believe, oh, wait a minute, we're very wrong here on Fed. The Fed's likely going to have to raise in December, and maybe even the dots will suggest, no cuts for next year. That would scare, I think that would scare people and say, shoot, they're really going to have to cause a much bigger recession in 2024. And I need to kind of start getting out of equities now. I think that on the flip side, if we got a cool inflation print and continue to get worse than expected growth data that rallied bonds, I think the market would still probably buy the big cap tech stocks into year end. And then we would walk in January where people started to worry about recession. So I think that's the setup for me. Look, can tech run run from now into the end of the year unabated? I mean, maybe it's possible. But I think if inflation is hot, it won't. And I think if inflation is cool, it might. But then we'll start to hear more about growth slowdown concerns, recession, and that's going to have to start getting priced in. Does that get priced in December, or does it get priced in January? Hard to know. I'll have to kind of watch as we go, but we know that the flows and the hedge buybacks are strong, and we know why there's a Santa Claus rally. And so we might have to wait for January to start trading that recession.
But they're going to front run it. I mean, they won't wait until January. So there will be, I think, just lots of opportunity for both directions.
Yeah, I think it's also interesting that there's for these big cap tech stock, the biggest open interest lines are January, because that's when the leaps are. So, if you think about just, position pinning and flows, often why the market starts the year, stronger than expected as some of those buybacks on hedges and whatnot, for those big cap tech stocks last, into January. But look, that might be when we start to get, a much more protracted down move in tech is, early next year, unless we get a hot inflation print, which throws the bond market back into disarray. I mean, there's been a big move lower in the move index over the course of the last few weeks, right? I mean, the move index has gone from, over 140 at the beginning of October, and let's say 135 in the middle of October. It's down to, printed 117 today.
And we've also come down into further inversion in the 2 and 10-year yield curve that I'm showing right here. So it's almost as if we've got some gaps to fill down here, right? We had made it all the way, or de-inverted, into a negative 0.13 from 100 from one solid point in July that matched basically the March low before the bank crisis. Anyway, long story short, as this comes down, we've got some opportunity for more softening in the 10-year unless they cut the short end, which is not expected. So what do you make of this as it kind of like dovetails with the move index coming down? Yields are softened. The longer,
I think. I mean, we'll see how the follow-on is, from today's poor auction and whatever's going on in Japan or whatnot. But look, the dynamics on bonds are, there's a growth dynamic, and there's an inflation dynamic, and then there's a supply-demand dynamic as well. I would say for bonds, I'm most concerned about growth. I think growth outside of the US is decelerating more aggressively, and that will eventually lead to a growth slowdown in the US. But on a very short-term basis, I am still concerned about sticky inflation. So again, it's this stagflationary environment that I'm concerned about. And so I don't think that's a great environment to buy duration and hold it and try to trade it for a trade. I think you're just better off kind of being upfront in T-bills or at the shortest maturities, because the Fed is not going to be cutting rates. So you can still earn 5.25%, 5.5% by being very, very close up front, because the Fed is not cutting anytime soon. On the back end, I don't want to own the 10-year. I certainly don't want to own the 30-year, because I'm very concerned about if and when we go into a recession in the US, deficits typically explode higher by 3 to 6% of GDP. So we're already running 7% of GDP deficit. In a recession, that's going to go to 10 to 15% of GDP. I mean, the numbers are massive.
Yeah, I think it's like 7.62%. It's like
right
more
now,
than 7.
and so we're going to 10+% of GDP in a recession. In an environment where foreign demand for treasuries is clearly moving lower, the TBAC report specifically spoke about this. This is something that we've been talking about for months. And Treasury finally admitted that, foreign demand is moving lower and is unlikely to return to historical averages unless the dollar depreciates massively, which I don't expect to happen yet. So if foreigners aren't buying and the Fed's not buying, who's buying? Household sector, which includes hedge funds, is buying, and they are the most price sensitive sector. And then the next sector to buy would be banks when they're forced to buy like they were today. And so, yeah, I think ultimately that's how you get a steepener happening. So I think, look, we've had a check back in the steepener trade. Steepeners got very crowded. So some position unwind here. 2s, 10s got to negative 11 basis points. It's moved back 25 basis points. We're negative 4, whatever. We're negative 40 now. Could stabilize around here. But I think ultimately by next year, you'll be in a position where this is positive and getting to much more, significantly positive. Yeah. I mean, even, the Druckenmiller trade is, and he doesn't talk about cost of carry or whatever, but he's just, kind of thinks eventually Fed funds goes back to 3 and 10-year, trades 5% plus. And so this 2s, 10s goes to 200 basis points. I think that's a reasonable chance of that happening by the end of next year and by the end of 24 and 25.
18 months.
Yeah. By the end of 24, by the end of 24 and 25, I think that's an environment that we're thinking about. Sure.
All right. So some questions. I'm going to just go kind of no particular order. I'm seeing rolling recession. 22 was tech, under the surface. We definitely saw that drawdown, 35% in NASDAQ, 20% in SPY. But 23 would be finance, obviously hit hard. It really kind of dead money in there right now with financials, regional banks, commercial real estate. What do you expect for the sector that will be under the most stress next year?
Look, part of what gets us back to 2% is inflation. Is we need the labor market to weaken because we need wages to weaken. And in order to get wages, and your cat would agree, in order to get wages down, we need stocks down. So we need a significant risk asset correction, really, in order to bring inflation back down to 2%. I mean, Powell even mentioned it today when he talked about the resilience of the U.S. economy. He said part of the reason, and it almost seemed to intimate that they didn't expect this at the time, but part of the reason that the U.S. has been more resilient is because the U.S. household sector is less sensitive to rate hikes because 2/3 of homeowners have mortgages that have a 3 handle and they're not selling their homes, and so in that case they're not being affected by the pickup in rates as much. And similarly, many corporates fall into a similar category where they just don't have debt maturities yet. They were able to roll their debt at very cheap cost of capital. And so that's why we don't have a credit crisis either. So that's allowed inflation to be stickier than they otherwise would have thought in light of 525 basis points of interest rate hikes. So
because things hold their value in an inflationary backdrop, it makes a lot of sense. So houses are, and what was cars, but houses are still the best inflation protection that we've got as homeowners.
So I think in order for this to really work, equities and risk assets need to get hit materially because that will hit the wealth effect and that will hit corporates who then cut jobs. So you ask me like what sector? I mean, it's more of like a broad-based kind of, sector.
I got to interrupt real quick. Or we could have the fiscal house, get their act together and put them on a diet, or otherwise
that's impossible. That's impossible.
Austerity of some kind.
That's impossible.
Or raise taxes to offset.
Impossible.
There are some other options that are not popular and a political suicide, but why does it have to be jobs?
Because that's how this works. Unfortunately, I mean, I think that you have to think about like what are the inhibiting factors and where can we see momentum? And the economy is the private sector and the public sector and import export. And so if you want to talk about the government sector, the government is dysfunctional. We may shut the government down next week at this point. I mean, I don't really think that's necessarily a market moving event, although I guess it could be if we shut the government down. Now, Treasury will still be able to issue debt and will still be able to. So, is that really a reason to be? Yeah, maybe that's a reason for people to get scared. They want to hedge some government shutdown because government employees aren't going to get paid for a few weeks, although they get all that money back, and that's going to lead to. But it's not really. I don't really know if that's a tradable thing. But
it isn't a spikes unemployment rate, and it just automatically kind of triggers the recession risk pulled forward. But I know we're getting a little bit off.
But I'm saying so the government is not going to be able to cut spending. So, actually, there was something came out today, which is interesting. The IRS basically has raised the standard deduction levels for next year again to kind of deal with inflation. So basically what that means is that everyone's going to be taxed less next year for making the same amount of money. So this happened this year because of inflation, and it's going to happen next. They basically raised the income tax brackets where you get taxed at incrementally higher rates. So, because those are inflation adjusted income tax brackets. So again, that's going to put pressure on the revenue side of the government's balance sheet, and it's going to leave more money in people's pockets for spending and inflation. So,
and it's also going to make the fiscal deficit larger. Assuming this, I'm not a tax expert, but basically you've already highlighted that the bond issuance for Q4 is bigger than Q3 of 2023, and the bond issuance will be even bigger for Q1 of 2024 than Q4 of 20. So it's a rolling snowball. Okay, so what one of the questions in here about the sector, first of all, the weakest, best swag, it's always 2022, my bet would have absolutely been and was NASDAQ underperformance. 2023, it's unattractive risk reward. I don't know, right? So this is really tough. Going into 2024, I can see where, in my thesis anyway, the dollar is going to grind lower. And I see that as potentially some tailwind for some select large cap stocks that derive revenues from abroad. It helps with their currency conversion, but ultimately a lot are going to get hit. So for me, that's a tough one. It really is. For sector weakness, I'm still going to go with, at some point, the recession risk gets pulled forward, and even then you can't hide in NASDAQ. Concentration risk, which is basically the risk off trade. Yeah, but I know that's hot.
I think you want to be, I think it's more like the names, right? The names with levered balance sheets or operationally levered names. I think that's where those are the ones that have that get hit the worst. The ones that have to refi debt next year.
We can agree on that.
So, yeah.
What about the rest of the private business? Generally small, medium size. You were talking with your thesis about the large cap stocks that have ticker symbols. And this is a really good question regarding private businesses, small, medium size, that don't have a continuous price ticker, have to operate based on fundamentals of their business, and also cost of capital. So let's get to the getting to the question. More of a challenging economic backdrop with slowing demand, and we have seen this the tight margin control in the earnings reports that have come out so far on declining revenues. So at some point, this is going to hit. Layoffs, I think, is kind of the gist of it. So from a close with the consumer, obviously has to roll over as well. With about 50% of the labor force in the US being in these smaller businesses, why couldn't layoffs there be enough to start an unemployment spiral, even if the Magnificent Seven don't fire everyone? You want to kind of take it?
I think that is what's going to happen. Right. I think we're going to see, the rolling recession will hit the smallest companies, that have no pricing power and have more limited access to capital and and limited, let's say, international opportunity. Those will be hit the worst first. And so, and we're probably already starting to see, some of that in certain areas. But, we need to hear that, these big, remember last year when we were getting big layoff announcements from Meta. We were getting layoff announcements from I think even Amazon. We may not get that, but we're going to start hearing, maybe it's healthcare, just areas where the labor market, or where the employers basically have to come out and start laying people off, or we're just not going to get back to 2% inflation, right? So there is a scenario where we just keep playing, we kind of just keep playing this game, and inflation doesn't go back to 2%, and the dollar really weakens, and risk assets kind of move higher as the Fed says, we're not going to get to 2, we're going to be comfortable in the 2 to 3 camp, and they don't really push the envelope to lead to a massive recession. I don't think that's a likelihood, but I do think some people believe that's the case. They believe in this kind of golden path, immaculate disinflation scenario where we won't need a lot of layoffs and prices will continue to just kind of fall graciously towards 2%. I just think that in an environment where it's clear that unions are kind of picking up power, right? Which is the SAG union just, completed their strikes yesterday.
Kaiser, they agreed
Kaiser,
today. Mm-hmm.
Autos, pilots, and the result of these negotiations are not wages are going up by 2% next year. The result is wages are going up high single digits. And the more that folks see the gains that are being made by unions, the more likely folks are to join unions, which membership is at a fairly low level, but going higher. So there's going to
Even
be...
Biden came out talking about Tesla today, which helped our
someone brought this
short.
Somebody brought this point up. I forget where I listened to this, but when you think back to the early 80s when we had this wage price spiral, Reagan busted the air traffic controllers. He busted the union. He basically said, you go to work or everybody gets fired. You now have a president who is basically going and walking and standing in the picket line with the striking workers, right? I mean, this is a very different administration, a very different mentality as it pertains to labor strength and labor momentum and wage momentum. Now, we don't know if Biden and the Democrats are going to be the winners in for 2025 through 2028, but they're all going to be there next year, and so there's going to still be a lot of momentum for unions to try to extract more from companies, and it makes it's going to be more difficult than, if that's the case, for the Fed to bring inflation back.
But it also, I think, is not going to. I don't know. I have a different opinion about the Fed hikes. Triggering inflation or higher wages, higher incomes, more demand, more spending, which triggers more inflation. So for me, I think they're going to stay kind of firm in the pause backdrop and kind of see where things play. Plus, they're playing second fiddle to Yellen and all the games that are being played with issuance, whether it's T-bills and or bonds and dollar swaps and Bank of Japan. We got to talk about Bank of Japan because that's a burning question. They came out yesterday and had a few. I don't know if you had a chance to take a look, but they UATA did some speaking, right? And then there was an article that came out that kind of intonated they might be seriously considering pivoting in January. A lot of rumor, a lot of speculation. 30 years of recency bias doesn't mean they're going to turn on a dime, but it was a trial balloon nonetheless. So any thoughts? Because I'm definitely getting a question from Marcus. When will UATA stop trying to jawbone himself a free lunch and step into the markets, meaning the free markets? And what to look for? Do you believe in the carry trade risk in the dollar yen? Seen it compared to the financial crisis, there was a clear unwinding on the charts. And with that, I have to bring up, because I saw that question coming a mile away. This is why it matters. All right. So talk to the carry trade unwind potential and specifically why it affects U.S. markets and interest rates.
Look, Japan, debt to GDP in Japan is the worst of any country out there, right? So, 250 to 300, I forget the exact number, but it's north of 250% of GDP. So first principles would suggest that if interest rates move higher in Japan, this is a major, major problem in Japan. So that is why they are going slow to allow rates to rise. Now, as their rates are structurally lower than everywhere else in the world, this is putting significant pressure on the yen. And so you're in to have this situation where either the yen is going to keep depreciating, or the government, the Bank of Japan, are going to come in, protect the yen, and then allow rates to rise, which is then going to bankrupt the government. So I think what wins out in the end is that rates don't move higher rapidly, that the yen takes the fall even further from here. And as long as it happens in a gradual pace, Japan should be very comfortable with this. And I think they are. And I think $150 yen was like a fake, oh, we're so scared type of situation here. And we don't, but now we're,
already 151
now
plus.
Now we're a week gone, and all of a sudden, right? Like no one's really saying that they have to intervene anymore. So we'll see. I think what's going to wind up happening is I think dollar yen is going to continue to move higher. I think JGB yields are not going to explode higher because they can't. And to the extent that there was concern that either one of these things was happening too rapidly, and you flip back to that other chart about what Japan owns, Japan has an important lever because they have a massively positive net international investment position, particularly, their ownership of U.S. assets and U.S. treasuries. And so they can always sell treasuries in order to raise dollars when needed, to slow down the pace of yen devaluation or to slow down the pace of JGB weakness. So
but
I
you're
think
working right into my argument of dollar is going to grind lower.
Right. So I think what Japan is trying to do is they're just trying. Look, I think all these central bankers, and I said it today on Twitter, but I think all these central bankers are trying to do is continue to buy time. Right. They're always looking to just buy time for whatever grand scheme they have, whether it's to bring inflation down to 2% if you're the Fed, or to bring inflation up to 2% if you're the BOJ, and that eventually, everything is going to be fine. And in reality, all they're doing is they're just deflating currencies, and we're, having, real inflation and real loss of purchasing power over time. But so I think the most likely scenario is Japan slow plays this. Dollar yen continues to move higher. Japan's competitiveness improves as the yen weakens. Japan is, a very integral part of the G7 developed market supply chain, the non-BRICS, non-OPEC supply chain. Japan is part of that, right? Japan is the US, Europe, Japan. So as the US, as the developed world starts to shift its focus of its supply chain from China and from EM and from BRICS out of there, Japan is a likely recipient of capital in order to elongate your domestic supply chain for the US. And so I think Japan is very well set up to benefit from this deglobalization trend, and a weak yen with low rates kind of fits perfectly for them. So I think that is ultimately how this plays out. And I don't anticipate that they're going to rapidly kind of get out of their ultra loose policy because it doesn't really behoove them to do that. And their inflation is under control. And particularly if energy doesn't move materially higher. Now, if it does, this creates problems for them. So I think they know that, and they're when energy is up, they're more likely to sell U.S. Treasuries in order to try to get energy down. I think that, and now that the energy is back down again, they can allow dollar yen to move back higher.
All right. So you are not believing that there's going to be any transition this year or next. The games they will play continue until they can't.
Yeah, look, I think is it likely that they're going to keep tinkering with policy? Maybe will they bring up the short rate to zero? Exit negative. Sure, I think that, but I don't think these are moves that are going to be moves that we need to be focused on kind of every day, every hour. You know what I'm saying? I think that because the biggest risk is that they sell their U.S. Treasuries in a large way. That is the biggest risk. And so if the dollar yen gets disorderly, then they can come in and they can sell U.S. Treasuries in order to slow that down. And if that's at a time when the U.S. is trying to issue more U.S. Treasuries, which we know is going to, it's always happening, that is how this risk gets out of control. But I would imagine that there is constant communication between the BOJ and the Fed and between the MOF and Treasury to try to make sure this is not done in a way that we screw each other over.
Okay. A good question from Thomas. Why would the dollar, US dollar, go lower? Europe is worse off, right?
Yeah.
Germany already in recession, et cetera. Many European countries are suffering and close. Rates almost as high as in the US. ECB also pressured to keep the bond BTP spreads limited, so perhaps also closer to easing than Fed is, and Bank of Japan trying, but the dollar yen looks super bullish on a monthly, weekly. So why would Dixie roll lower? I'm not talking about a crash. I'm just talking about grind lower. But your view as well.
Yeah, I'm not an imminent dollar bear. I think the dollar is going to continue to move higher against the yen, against the euro, and against EMFX here, between now and the end of the year and into next year, until the point where the labor market in the U.S. slows enough that we could start to think about a rate cut cycle that brings in liquidity. So, no, I'm not a dollar bear. As far as all these structural things are concerned, with the dollar losing FX reserves and hegemony and the like, those are in play. But those are long tail factors that kind of happen over time. And look, I think the dollar is losing value versus gold, right? Gold's basically at the highs. It is losing value against Bitcoin again. And I think it will continue to lose value against, both of those assets. I think it's likely to continue to lose value over time versus oil and other commodities. But I don't think it's going to lose value against the euro, or the yen. And the RMB, I think, is, I don't know, mixed. I'm not really sure. And typically in a growth slowdown, dollar strong environment, the dollar would normally do better than EMFX. So I'm still for now a dollar bull. I think Europe is, I see a question there about Europe. I think Europe's growth momentum is way worse than the US. Their inflation situation remains not good. They have a sticky labor issue, but they also have a unilateral inflation mandate. So if oil and energy do fall, that gives them some ability to cut policy rates sooner than you would get in the US, which could lead to a weaker euro in time. So yeah, I think the question, I don't see it likely that the dollar is going to be materially under pressure until the point where growth slows down enough here that the Fed does start to cut rates. And then we could start to think, then at that point, when we're talking about potential recession and the deficits in the US blowing out to 15% of GDP, that's when gold is going to go to, 2,500, 3,000.
Timing matters in this
Bitcoin's going to go to 100,000. And then, that might be an environment that, a scary environment that folks aren't prepared for, but that's not a 3-month view. That's more of maybe a 6.
Right. Now, I wasn't referring to right now where we have softer, dollar and yields serving as a tailwind for equities. I'm talking as rates fall, and we already see Fed rate cuts getting, surging, demand for the dollar and U.S. Treasuries will fall together. But this is down the road. And I think we haven't been tipped into that point yet, because wage inflation has delayed recession along with U.S. government spending, et cetera, et cetera. All right. So I know it's 5:00 and you have a hard stop very soon. So what other questions do you want to kind of quickly answer? And then we'll call this power hour.
I have a few more minutes. Look, I think we're in a very challenging environment. I think the playbook that folks are used to for the last decade plus 15 years, where the Fed imminently reacts to either growth slowdowns or financial market instability. I think that view is being challenged more so on the growth side than maybe on the financial instability side, right? Because we have seen them step in for SVB, and it's not clear that the Fed would allow a dysfunctional U.S. Treasury market to persist for a very long period of time. So, that there is a Fed put around that. But as far as the Fed reacting with stimulus to a growth slowdown, when there is sticky inflation, the market needs to move back beyond a 10 to 15 year look back. It needs to go back 30 years when the Fed did not do that. And if you really listen to what the Fed is saying and doing, they are not going to be providing stimulus. Powell was pretty adamant again when asked. He said, we're not even thinking about cutting rates. This is kind of the opposite of, 3 years ago when he said, we're not thinking about raising rates. So this is not a Fed that is going to be rapidly addressing the slowdown that is coming from the tightening that they've already done and will continue to be doing while remaining on hold. So I think we need to be very mindful of that. Cash is still a very good asset, earning north of 5%. And I think we need to just, be cautious. There is an expectation for a substantial reacceleration of earnings growth in 2024 and 2025. I don't see how that's possible in light of, the tightening that's already been done and is going to continue to happen. And so, and I think that if the wage environment in the U.S. stays firm, it's going to be very difficult to get that down to 2% without higher rates. And so I think we're setting up for a very challenging 2024 that ultimately, if I step back, what I think is going to happen in 2024, we really should have had this in 2023. And we were on pace to get it in 2023 until the Fed came in and did the BTFP, right? I mean, we had all signs of the tightening that was going on in 2022, the start of QT and the big moves in rates. It was leading to a slowdown. And then at the end of 2022, the market started to say, okay, the slowdown's here. They've played the same game. Okay, the slowdown's here. Let's the Fed's going to stop. And then January came in, the data was a lot better. And the Fed said, nope, we're going to keep going here. Then the market started to get scared. Bonds sold off aggressively. We started to have some banking concerns in the early part of March. If we would have just let that play out, hindsight is 2020, I guess, right? But some banks would have failed. It would have been, we would have had our recession right there. Fed would have, inflation would have got slayed right in its tracks. Now, would the S&P have been down 30% from that? Probably, maybe more, but instead, what did they do? What did they do? They came in, they set up a facility, they basically saved every bank, and they allowed for the recession to get pushed out another year, effectively, because every company then said, oh, thankfully the Fed's here. We don't need to lay anybody off. Every good. What happens in in June, July period, markets rip higher. Everybody's happy again. And all of a sudden, look at that. Core services inflation now is up 3 months in a row, and it's probably going to make it 4th month in a row, next week. And the Fed's sitting there saying, oh man, we're still dealing with it. So the recession that we should have had in 2023, now we're going to have in 2024. It's going to be harder to navigate that from
that's going to be tough in an election year. They're going to push that off come hell or high water.
Look, I mean, it's very possible.
Intervention is the word for
it's
next
very
year.
likely. I think it'd be very possible that we would see, playing this forward, the Treasury run down the TGA in the 6 to 8 weeks before the election and juice financial markets and juice the economy in order to procure, Democratic wins. I very much believe that could happen. So that's 9 months. That's a year from now. So we'll cross that bridge.
We'll have a few more of these before then. All right. So thank you so much. He's got coaching duties, so we're getting tapped off here. But I think we covered everything as best we could in the time we had. Thank you so much for joining. Again, Samantha LaDuc, Craig Shapiro, LaDuc Trading. We wish you a great evening. Bye.
Thanks. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.